India. Now, let us look at the accounting principles. Now, accounting principles can be divided into two categories: accounting concepts, accounting conventions. Now, the accounting concepts are those things which are necessary upon which the accounting is based. It is a term used to connote accounting postulate, and these accounting concepts are business entity concept, money measurement concept, cost concept, going concern concept, dual aspect concept, realization concept, matching concept, accounting period concept, accrual concept. And let us look into the details of these concepts. Now, business entity concept. Business is treated as separate entity from its owner. The owner and business are separated according to this concept. All the transactions of the business are recorded in the books of accounts from the point of view that the business is treated separate from the owner along with the creditor. Now, the second one is money measurement concept. In accounting, we record only those transactions which are expressed in terms of money, which means a fact which cannot be expressed in monetary terms cannot be recorded in the books of accounts. Only that which can be converted into monetary units can be recorded in the books of accounts. Now, the next one is accounting period concept. In accounting, life of the business is perpetual. We set up business with a purpose that it should run into perpetuity, that is forever. But still, it has to report the results of activity undertaken during a particular period of time. This particular period of time can be a week, can be a month, or can be a year. Now, in India, we follow the accounting period as 12 months, starting from 1st April of the current year till the 31st March of the next year. So, this is 12 month span. Now, the accounting period here, it is considered as 12 months, that is 1 year. Now, let us come to the cost concept. Transactions are entered in the books of accounts at the amount actually involved. We do not consider the inflation, we do not consider the deflation, the increase or decrease in the value of the materials or the assets we do not consider. For example, if a company purchases a car for 150,000, the real value which is 200,000, the purchase will be recorded as 150,000 or 1,50,000, not 2 lakhs. Whatever be the value in the market, we record with which we have purchased the transaction, we have purchased the asset. And this is one of the most important concepts, and it prevents arbitrary values being put on the transaction, fiduciary values put on the transactions. Now, going concern concept is another concept we are going to look at. It is under the premise that the business will exist into perpetuity, as we have discussed, and the transactions are recorded from this viewpoint. The entity is assumed to remain in operation as long as possible till it is wound up by the operation of the law. That means the business entity is set up for a long term to accomplish its long term objectives. The time duration is long enough to accomplish the objectives and the mission of the organization. Now, we look at the dual aspect concept. Now, each transaction has two aspects, as we discussed initially: the debit and the credit, the sacrificer and the beneficiary. The receiving entity will be debited and the beneficiary will be credited. This is a principle which is core in the entire accounting process. Now, for example, the proprietor of a business starts his business with cash of 1 lakh. Machinery worth 50,000 is bought and the building worth 30,000 is constructed, then this fact is recorded in two places, that is assets account and the capital accounts. The capital of the business is equal to the assets of the business. Now look at this, the capital plus liabilities is equal to assets. The capital plus liabilities is equal to assets. We procure the assets with the finances raised through capital and through liability. The capital is the amount contributed by the owner or the promoter or the investor. The liability is the external borrowing from the financial institutions or the banks or an individual. So with the help of capital and the external borrowing, we procure the assets. So therefore, the dual entity concept gives us an equation, capital plus liabilities is equal to assets, or capital is equal to assets minus liabilities. If you deduct the value of the external borrowings from the assets, you will get the value of the capital. Now this is known as accounting equation. Capital plus liabilities is equal to assets. Capital is equal to assets minus liabilities. This is accounting equation. Now let us come to the realization concept. This concept emphasizes that profit should be considered only when realized. Accounting should be taking into consideration profits only when the same have been realized. Unless they are realized, we cannot record in the books of accounts. What we cannot realize can never enter into the books of accounts. Now let's come to the matching concept. Matching concept requires that expenses should be matched to the revenues of the appropriate accounting period. Now we have discussed about accounting period. The accounting period generally is for 12 months. Now for the 12 months, you had to match all the expenses against the revenue. What for? Now we have two objectives. To know the net result of the business operations, we prepare income statement. To know the financial position, we prepare balance sheet. Now here we match in the income statements all the expenses against the incomes, so that we come to know what is the value of the profit or the loss, that is net loss or the net profit, net income or the net loss. Now we must determine the value of revenue earned during a particular accounting period and the expenses incurred, and the resulting the net result, the net difference is either profit or loss. Now let us come to the accrual concept. Accrual is concerned with the expected future cash receipts or payments. Now accrual is simply it is becoming due. Accounting attempts to recognize non-cash events and circumstances as they occur, that is, whether received or paid. Once it becomes due, we recognize that event, we recognize that business transaction and report into the books of accounts. For example, purchase and sale of goods on credit and wages and salaries outstanding. Now we have not paid the salaries, we have not paid the wages, it is still outstanding, but still we treat it as if it is paid. So once it becomes due, it is an obligation, so therefore it is an expense. Now we have sold the goods, still we have not received the cash, still we treat it as sales revenue and account for it. So the accrual concept says whether it is received or not, whether it is paid or not, once it becomes due, we will record in the books of accounts. Now let us look into the stable monetary unit. The concept presumes that the purchasing power of monetary unit, say rupee, remains the same, it remains the same throughout, thus ignoring the effect of rising or falling purchasing prices, that is, inflationary situations are not taken into consideration. We understand that the price, the value of rupee, the value of dollar remains the same. Now let us look into, now we have seen the accounting concepts. Now let us look into the accounting conventions. The term convention is used to signify the customs and traditions as a guide to the presentation of the accounting statements. Now, in order to enable the management to draw important conclusions regarding the working of a company over a few years, it is essential that accounting practices and methods remain unchanged from one accounting period to another accounting period. So, the comparison of one accounting period with that of another is possible only when the convention of consistency is followed. So, what we understand is the convention of consistency is the first consistency